Your Bitcoin-denominated convertible bond is a big step. What problem were you trying to solve when you designed it?
So what we wanted to solve was, in Bitcoin Treasury companies, historically, you've seen periods of high multiples of NAVs and low multiples of NAVs. Now, in a high MNAV environment, we have the tools in place to accrete value to shareholders and increase Bitcoin per share. In a lower MNAV environment, we have tools like the convertible bonds that we're designing to be able to benefit the shareholders and benefit the balance sheet. And the problem that we've solved with that is there are institutions around the world holding significant amounts of Bitcoin. You have one of our key strategic investors involved in the NASDAQ listing that's holding 35,000 Bitcoin. You have hedge funds in Switzerland with one of our board advisors, Richard Byworth, that's holding 5,000 Bitcoin. But there are many institutions around the world holding this asset now. What we wanted to provide them was a limited downside risk for them. So there's a 2% fee for our convertible bonds, which means over the 12-month maturity, the downside for them is 2%. We're selling them at a premium, but the upside for them, when our share price outperforms Bitcoin, is high. So they're bonds that appeal to institutional investors holding the core asset of Bitcoin and wanting to use that into the future. And the solution for us is it allows us to demonstrate and show where we will be from a balance sheet perspective, provided that our share price hits the level of 120% outperformance on the conversion price. Then we know we can move that Bitcoin from being held encumbered onto the balance sheet unencumbered by repaying those bonds with shares.
In plain English, how does the Bitcoin price adjustment work and why is it fair to both shareholders and bond investors?
In plain English, the Bitcoin price adjustment, or the Bitcoin differentiator on the XCE Bitcoin bonds, allows the bonds to track the Bitcoin price. So for investors, they know that they are measuring the return based in Bitcoin terms. So if the Bitcoin price is here and the share price is here, then we're selling them at a 30% premium. And let's say the Bitcoin price, so premium's there. Let's say the Bitcoin price moves up, the conversion price rises as well. And if the Bitcoin price moves down, the conversion price comes down as well. So it's the environment where our shares outperform Bitcoin that they can be converted early. So in simple terms, if you're an investor in those bonds, you're not going to have an environment where you're asked to convert and our share price hasn't outperformed the underlying asset, Bitcoin.
Why was it important to denominate the bond in Bitcoin rather than pounds, and who do you expect to be most attracted to it?
Two reasons it's important. One, it allows us to actually accept Bitcoin from the institutional investors rather than give the business an area of, it limits risk. So if we're receiving it in pounds or US dollars and then buying the Bitcoin, there's a risk between that. So it allows us to accept the underlying asset of Bitcoin, and it allows the investor to know that by doing that, if they're buying a bond for 10 Bitcoin, or let's say if they're buying a bond for 100 Bitcoin, over 12 months, they know if the upside is hit and the conversion happens, then they've got the benefit. But if it doesn't, we get to the end of that 12-month period, that the same Bitcoin would be returned to them.